Hi everyone and welcome to the Actually Business World. Today we're going to talk about 5 ways the 1% save their money. But before, don't forget to smash the like button and subscribe to our channel. Now let's begin. Number 1. They pay with cash. One drawback of credit and debit cards is that they encourage you to spend more than you should and more than you intend to by giving you easy access to capital. It simply doesn't feel like you're spending more money when you're using credit cards, since you can't feel the money leaving your wallet. Just as cards encourage overpaying for one item, they allow you to buy more things than you mean to. Stores are designed to display products appealingly and encourage impulse buying. Multiple studies have found that people will spend more when they use a credit card compared to cash. What can you do to avoid this? Generally speaking, only carrying the cash you're prepared to pay for a given product will prevent you from buying the next level up and paying for features you don't need. That's the best way to keep shopping within your budget. If you're motivated, you'll find discounts or cheaper alternatives to your regular brands to make that cash go further and maybe earn yourself a luxury item with the cash left over. There's also a practical security advantage with cash. Although debit and credit cards often have personal identification numbers and chips for extra security, there is less risk of identity theft or your information getting stolen online when using cash. Cash is only protected by your ability to defend it should someone try to take it from you. With cash, your spending is straightforward and there is less risk of identity theft. Number 2. They track the expenses. Tracking your expenses is one of the key factors in making your budget work for you. If you do not know how much you spend each month, you cannot tell when you've overspent. Even the small expenses can cause you to blow your budget. There are several options available to track your expenses. One of the simplest is a written ledger or tracking system. It may be even easier to choose budgeting software that works with an app to track expenses on your phone. It'll allow you to keep up while on the go. It's important to know how to track your expenses in a notebook. It can also help you become more aware of what you're spending and where you're spending it. That can help you identify the areas where you need to make changes. First, you'll need to have your budget with you. You should also have a notebook available to you. You can divide your paper into about 3 columns apiece. You'll need to write down each budget category at the top of the column. Then, you need to record the assigned amount next to it. If you have not created a budget and are tracking your expenses so that you can create one, then you should decide on basic spending categories such as utilities, food, rent, eating out, fun money, and insurance. Record each of these at the top of the paper. Next, you'll need to take time each day to record your expenses. As you record each expense in a category, you'll need to keep a running total of how much you have left in that category. Simply subtract the amount you spent from the current total and record the answer. Number 3. They pay lower taxes. In the US, most people make their money from a regular job. They get a paycheck and pay income tax. But the richest Americans, the top 1%, make most of their money from things like investments in real estate or the stock market. Those investments are taxed as capital gains. While federal income tax has a maximum rate of 37%, the tax rate for capital gains tops out at just 20%. Billionaire Warren Buffett has repeatedly pointed out the disparity, advocating that rich Americans pay higher taxes. To make that argument, he famously noted that he pays fewer taxes on a percentage basis than his secretary and other employees, since a bulk of his wealth is in stock rather than wage income. Many of the wealthiest Americans have found ways to be proactive with tax planning and financial planning to minimize the taxes owed. In many cases, they've eliminated their federal income taxes. In comparison, many of the strategies he used to skip out on paying the IRS are out of reach for the average American. Some of the tax-minimizing techniques used by the other billionaires are more obtainable for the merely high-income and/or high-net-worth Americans. It isn't what you make, but what you keep. Taxes are about as low as they have ever been. They will likely be higher in the future. The desire of those with high incomes to minimize their taxes is growing, leading to a whole new generation of financial planners who go beyond just investment advice and help their clients minimize taxes along the way. Number 4. They set monthly savings goals. Setting specific savings goals will help you to begin saving money. When you're just putting money into the bank on a regular basis, it can be easier to withdraw it for various reasons. You can easily overspend and use some of the money you had earmarked for savings. For these reasons, it's important to save for a specific target or goal. You may be working towards several objectives at once, or you may be focused on one specific goal that you want to meet. You need to determine what you're saving money for. Your savings goal may be for a down payment on your home. You may be saving for a dream vacation or to pay for your next car. You may be saving for retirement or for an emergency fund. You may be saving for all of these reasons. In order to reach your timeline for your savings goal, you need to determine how much you need to save each month. This should be pretty straightforward for most of your goals, but your retirement account will have to be calculated to account for both of your contributions and the rate of return that will be added to it as it grows. A financial advisor can help you with this, as can many online calculators. You should also find the right type of account for your savings goal. Number 5. They avoid inflation. Despite the lack of confidence that most people express about stocks, owning some equities can be a very good way to combat inflation. Think of your household as a business. If a company cannot properly invest its money in projects that will deliver a return above its costs, then it, too, will fall victim to inflation. The basic premise of business success is that corporations will sell their goods at increasing prices, which will lead to elevated revenues, earnings, and, inevitably, stock prices. Some of the best stocks to own during inflation would be in companies that can increase their prices naturally during inflationary periods. Commodity resource companies are one example. Products like oil, grains, and metals enjoy pricing power during periods of inflation. The prices of these items tend to go up as opposed to, for example, the price of a computer, which is subject to manufacturer and distributor price adjustments. When done for the right reasons, like buying a home to live in, real estate is always a good investment. Problems occur when a buyer's goal is to flip the property they just bought at a profit. Although experienced real estate investors are able to find hidden values in properties, the average person should focus on purchasing a home with the intent of holding it, even if only for a few years. Real estate investments do not typically generate a return within several months or weeks. They require an extensive waiting period in order for values to increase. Thanks for watching. We hope you really enjoyed this video.